Hello everyone, I'm Twinkle Jain and today we are diving into the intriguing world of mutual funds, specifically focusing on the role of fund managers. Have you ever wondered who's behind the decisions that affect the performance of your mutual funds? Well, that's exactly what we are going to explore today. How fund managers make those crucial decisions and how their expertise impacts your investment returns. Let's start with the basics. Who is a fund manager? A fund manager is essentially the person responsible for making investment decisions on behalf of the mutual fund. They manage the fund's portfolio, deciding which assets to buy, hold or sell, all with the goal of maximizing returns for investors. Think of them as the captain of a ship, navigating through the financial markets to reach a profitable destination. But not all fund managers are the same. Their investment philosophy and strategy can vary significantly, which in turn affects the performance of the fund. Some fund managers follow a growth strategy, focusing on investing in companies with high growth potential, while others might prefer a value strategy, investing in undervalued companies that have the potential to perform well in the long run. Then there are those who adopt a blend strategy, combining both growth and value investments to balance risk and return. Now, let's talk about the key factors that fund managers consider when making investment decisions. First is market conditions. Fund managers constantly monitor the overall economic environment, including factors like inflation, interest rates, and geopolitical events. These factors can have a significant impact on market performance and consecutively on the fund's returns. For example, during periods of high inflation, a fund manager might shift investments towards sectors that are more likely to benefit, such as commodities or energy. Second, company fundamentals. Before investing in a company, fund managers thoroughly analyze its financial health. They look at metrics such as earnings, growth, debt levels, profit margins, and cash flow. This analysis helps them determine whether the company is likely to generate strong returns in the future. For instance, a company with consistent revenue growth and low debt is generally considered a safer investment. Third, valuation. Fund managers assess whether a stock is overvalued or undervalued by comparing its current price to its intrinsic value. They might use various valuation methods such as price to earnings ratio, price to book ratio, or discounted cash flow analysis. If a stock is undervalued, the fund manager might see it as a buying opportunity. Fourth, risk management. Managing risk is a crucial part of fund managers' job. They employ various strategies to mitigate risk, such as diversification, spreading investments across different sectors, industries, or asset classes. This reduces the impact of any single investment's poor performance on the overall portfolio. For instance, if a fund is heavily invested in the technology sector, the fund manager might balance this by investing in defensive sectors like utilities or consumer staples. Fifth, portfolio rebalancing. Over time, the performance of different investments in a portfolio can cause the asset allocation to shift. For example, if equities perform exceptionally well, they might start to make up a larger portion of the portfolio than originally intended. Fund managers regularly rebalance the portfolio by selling overperforming assets and buying underperforming ones to maintain the desired asset allocation. One interesting aspect of fund management is the active versus passive management debate. The success of an actively managed fund largely depends on the fund manager's skill, experience, and ability to predict market trends. This brings us to the question, how do fund managers impact your returns? The performance of your mutual fund is directly linked to the decisions made by the fund manager. A skilled fund manager can add significant value to the fund by making informed investment decisions that generate higher returns. Conversely, poor decisions can lead to underperformance, which is why choosing the right fund manager is critical when investing in mutual funds. For example, consider a scenario where a fund manager accurately predicts a market downturn and shifts the fund's investments into more defensive assets like bonds or gold. This move could help protect the fund's value during the downturn, resulting in better returns for investors compared to the funds that remained heavily invested in equities. But remember, even the best fund managers can't predict the future with certainty. Market conditions can be unpredictable, and no one gets it right all the time. That's why it's important to evaluate a fund manager's track record over a longer period rather than focusing on short-term performance. Look for consistency. Has the fund manager consistently delivered good returns over several years, even during market downturns? Another important aspect to consider is the fund manager's experience and expertise. A seasoned fund manager with years of experience navigating various market cycles is more likely to make informed decisions. Additionally, the size of the team supporting the fund manager can also make a difference. A well-resourced team of analysts and researchers can provide valuable insights, helping the fund manager make better investment decisions. The role of a fund manager is pivotal in determining the success of your mutual fund investments. By understanding how fund managers make decisions and their impact on your returns, you can make more informed choices when selecting mutual funds for your portfolio. Found this insightful? Keep a lookout on this space for more such content. This is Twinkle Jain, helping you make smarter investment decisions every day.
Investment in securities market are subject to market risks. Read all the related documents carefully before investing.